Hello, Jim. This is Dean from the Upper Midwest. I have a simple question about withholding taxes and retirement. I may be about 10 years or so away from retirement. Ever since I was 16 years old and got my first job at a local pizza place, I have earned W-2 income. I have always filled out the W-4 for withholdings and adjusted them accordingly. Now, when I retire, I will still have sources of income such as capital gains, dividends. Plus, I will be likely doing some Roth conversions for a tax deferred account, a cash balance plan that will become a traditional IRA. This is to minimize the RMD at 72. So, my question is, how does withholdings logistically work upon retirement when I no longer have a W 4? I don't want a penalty come tax time because I haven't paid anything. Thank you so much.
All right, Dean, good question. I think you're a repeat caller, as I recall, but welcome back to the podcast. Here's the deal. This is really obvious for those of us who've been self-employed for a long time. Each year, you have to get into the safe harbor or you owe penalties in addition to whatever taxes are owed. You have to pay the taxes no matter what. But if you don't get into the safe harbor, then you got to pay penalties too. So what's the safe harbor? Well, the safe harbor might be that you owe less than $1,000 in taxes. If that's the case, you're good. Okay. If you got to within $1,000 of what you owed, you paid $6,000 and you owed, $6,900, then you're good, right? Even though you underpaid your taxes during the year, you're okay because you're in the safe harbor. You still have to pay those taxes that are due, but that extra $900, but you don't have to pay any penalties. Another safe harbor is having paid either 90% of what's due if you're a low earner or 100% of what's due. Okay, if you paid everything that's due for the year, you're in the safe harbor and you don't have to pay any extra. Or you can pay 100% if you're a low earner or 110% if you're a high earner of what you owed last year. And that gets you into the safe harbor. So if your income doubles this year, you can dramatically underpay your taxes this year and settle up with the IRS on April 15th and still not pay any penalties. You still have to pay all the taxes due, but you don't have to pay any penalties. And so the goal for those of us who have to manage this crazy process throughout the year because we're self-employed is to get into that safe harbor. And the ways you get in there are you have money withheld by your employer. All of that counts no matter when in the year it was counted. Even if it's withheld on December 28th, it counts just like every other dollar that's withheld during the year. You can also have it withheld by somebody like Vanguard when you do a Roth conversion or when you do a RMD withdrawal or something like that. And that goes into that same withholding pot of money. Okay. The other thing you can do, if that's not enough to meet the taxes you have to pay, is you can pay quarterly estimated taxes. And those of us who are self-employed, we write a check every quarter. Okay, it's due on April 15th, it's due on June 15th, it's due on September 15th, and it's due on January 15th for each of the quarters respectively. Yes, I know those dates are not each 3 months apart. It causes me incredible cash flow issues this time of year every year because I only have 2 months of income, and yet I got to somehow pay 3 months of taxes in June. But such is life, right? You get 4 months to make the last one, you get 2 months to make the second one, you get 3 months for the other ones. It's kind of weird, but that's the way it works. So if you are not having enough withheld in retirement by having Vanguard or whoever withhold your money from RMDs, then make quarterly estimated payments. So if you make a big Roth conversion in the fourth quarter, send in a fourth quarter estimated quarterly payment. And as long as you're doing it more or less as you go along, because it's a pay-as-you-go tax system with the feds, not necessarily all the states, but with the feds, it's pay-as-you-go, then you're okay. It's easier sometimes to just pay equal amounts each quarter, and then the IRS doesn't even bat an eye, and it saves you one form at tax time, rather than having to show that your payments actually line up with when you earned your money. But in general, that's the process. If you're not having enough withheld, you just make quarterly estimated tax payments. No big deal, although it can be complicated at times, so maybe it is a big deal. But I hope that's helpful to you. I can see why that would be a mystery if all you've ever done is had your employers withhold it. But once you've been self-employed for a while, which is really what a retiree is, it's not that complicated. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.
My dad, your host, Dr. Dahl is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.